Part 4 on our journey from bums to boys. In this video, I want to talk about mutual funds and some other investments that you can use, and some investments that I do use and I do buy. And I'm going to show you some of the investments that I'm currently buying every single month. But before we do that, in order to drive this concept of bum to boy into your head, I want to look at a few more examples of it. So here we go. Bum to boy. In this example, we have a tree-dwelling hobbit of a bum. Look at that bum. And look, if you save and invest, you can turn into this gift-giving boy. In fact, this boy, we're going to throw some quotes on because it's not really a boy, but you get the point. So here's a nice example of tree-dwelling hobbit of a bum to gift-giving boy. Example number 2. Look at this nudist colony bum. You don't want to be this nudist colony bum. What is that? You want to be this boat captaining boy. Boy with a lot of exclamation points. There's example number 2. Example number 3. Double chin selfie bum. Look at that selfie. You don't want to be in this boat. You want to be golden trout hunting boy with some tilt. There you go. So there are 3 examples of bum to boy. And with that, we're going to talk about what is a mutual fund. So, a mutual fund, simply put, is a simple and basic way to buy a bunch of stocks in one thing. So, if you Google what is a mutual fund and how it works, here we go. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. The combined holdings of the mutual fund are known as its portfolio. Investors buy shares in mutual funds. So basically what that's saying is that me, as an investor, I can buy a mutual fund and someone is managing that, and they'll distribute my money into a bunch of different investments or securities. And those might be stocks, they could be bonds, they could be short-term debt. But for this example, we're mostly going to talk about stocks and bonds. So let's look at a mutual fund that I own in order to get some concreteness to these words that Google throws you. So here we go. VTSAX. This is the name of a mutual fund that I own. And what these letters are, this is just called a ticker symbol. So I own this VTSAX, and it's basically a total stock market mutual fund. So why I bought this mutual fund is because I wanted to buy a lot of US companies and own them all, but I didn't want to have to go through the effort of actually finding all these US companies, however many there are, thousands of them, and buying a little bit of each of them in order to have a diverse portfolio. So in the last video, I talked about how diversity is very important because we don't want to put all our eggs in one basket, essentially. And so instead, we can buy a mutual fund, and it easily just distributes our money across a lot of different companies. So this is just what happens if you Google VTSAX. I buy this and own this. I put money into this every month. I like to use a website called Morningstar to kind of look at things a little more clearly. So I just went to this tab over here called Portfolio. I have this VTSAX pulled up, which is something that I put money into. And this is quite a popular mutual fund for many people. So what's in this, you might wonder? So right here, asset allocation. This is giving me a breakdown of where my money is actually going within this fund. So 98% of my money is going into US equities, which just means US stocks. And so this mutual fund is trying to basically buy almost all the companies in the United States that trade publicly for stocks. So for example, if I scroll down here, these types of sites give you incredible amounts of data. probably too much to ever understand unless you have a quantitative masters of finance like one of my friend's brothers, and he might know and be able to tell you what all this stuff means, but I can't. And so let's just try to figure out what's in this. Where's my money going when I buy this fund? And let's go down here and look, portfolio holdings. So when I put money into this, I'm actually buying over 4,000 different companies. So I don't want to go and find 4,000 different companies and put a little bit of money into each of them. I just want to buy this one fund and it'll do it for me. So that's the beauty of some of these mutual funds, is that you can be very diverse without getting this crazy complicated portfolio of all kinds of things in them. And so if we go down here, and this is going to tell me the top 10 holdings, which is just, you know, the most money, the top 10 most money I'm putting my money into, companies, I guess. So the first one here is Apple. Sorry, that was confusing. So my money is going into all these companies, essentially. Apple, Microsoft, Amazon, Tesla, Alphabet, which is Google, United Health Group, Berkshire Hathaway, ExxonMobil, Johnson & Johnson. And so there's 4,000 of these companies that my money is going into, 4,024. And so to me, that's a very nice way to diversify my money. This is essentially saying, if I put $100 into this mutual fund, 6.7% of that would go to Apple, 4.49 would go to Microsoft, and so on, for 4,000 different companies. And so essentially I'm buying into a huge portion of the US market. You know, all kinds of companies, tons of tiny companies that you've never heard of, you know, all kinds of companies, and I'm doing it with this one fund. And so this is an incredibly easy way to diversify and spread my money across a ton of different companies. And the overarching theme is that, let's say I own every single company in the US, some small portion of it. Essentially what I'm trying to do is say, if the US stock market as a whole increases, which we know from history it generally does, then so will my money. And that's what I'm trying to do. I want my money to essentially look like the stock market through this fund. And so if the stock market goes up, then you better believe this fund is going up with it. Because essentially the idea of this fund is to basically buy a lot in almost all the US companies. And so if the US stock market goes up, then this fund goes up. And so let's look at some of the past history. So, you know, whenever you're looking at stocks and bonds, you're always getting plots. People are always looking at these graphs. So let's just take a look at this real quick. If I go to maybe performance, will give me a better look here. Okay, so this is what I wanted to point out. This right here, total returns. So this is looking at each year how much money or how much gain or loss this fund is having. So let's look. This YTD stands for year to date. So this year, 2022, this fund is down minus 14.59%. And so what this could mean essentially is that on this compound growth calculator, this interest rate would be negative 14%. So you might say, wow, that's terrible. I'm losing a ton of money. And that's true. This year, the stock market has been going down quite a bit. And this is kind of shows that, because this fund is essentially tracking the US stock market in a sense, because you own a lot of the US companies. And so if this fund is down 14%, then that means the stock market as a whole probably is similar to that. And that's true. That's the case. But look at this. Look at all these other years. Last year, 2021, look, up 25.71%. So imagine taking this 25.1% and being like, putting that in right here, you get crazy numbers going on, right? And so this is a very concrete example of how volatile the stock market is. Last year we're up 25%, and this year we're down 15%. It's like coronavirus, a global pandemic, hits in 2020, yet the stock market is still up 20%. Who knows why that happens? And then look, 30% the year before, but then 2018 we're down 5%. So this is essentially, if you were only to buy this fund, if you put all of your investment money within your retirement account into this fund. So for example, in my Roth IRA, I put all of my money, all my $6,000 per year into this fund, then I could just use these interest rates as this value in this calculator. And so you can kind of start to see how crazy these interest rates are and how volatile they are, and they go up and down, and it's hard to predict. And so in general, we want to be diverse and we want to cover multiple grounds. So we don't want to just buy a stock. So I'm going to buy 4,000 stocks and essentially track the US market, because over time we expect the US market to increase. This kind of, like, in a way, comes down to capitalism. The system that we have in place is part of the reason why we're expecting this, this upward trend of all the companies in the US. So this is an example of a fund I own. So I put, like, some percentage every month of the money that I'm putting into my retirement accounts into this fund. Here's another fund I own. This is a bond fund. So this is another mutual fund that is buying bonds, essentially, and trying to cover the total bond market in the US. Oh, one other thing I wanted to point out here is that right here, this little guy, adjusted expense ratio. So because someone has created this amazing fund that buys into so many US companies, if you were to do that yourself, it'd be super time consuming and hard to do. And so because someone has, like, done this work for you, they're going to charge you a small percentage to buy this fund. So this 0.04% is how much they're going to charge you to own this. So for every $1,000 that I put into this fund, they're going to take $4 and say, okay, those $4 are mine because I've done this work for you. Pretty much all mutual funds have an expense ratio, and you'll come to see that if you care and look into this, this is actually a really good expense ratio. So this company called Vanguard has done really well at making mutual funds very inexpensive, which is awesome for us as investors, because we don't want to give money to investment advisors and stuff like that. We want the money ourselves. So this is a low expense ratio. I just wanted to point that out so you kind of have an idea of what that is. There's all kinds of things you can look at here. Minimum initial investment. So in order to buy this, you actually have to put $3,000 into it right away, which is what I did. And there's all kinds of stuff like that, but those two things are, could be important, because you might not have $3,000 to invest it right away. So there could be other options you look into if that's a barrier for you. But I just wanted to point that out. So here's another fund I own. This is a bond fund. So if you look at, like, what's actually in it, US equity, US stocks, it doesn't have any US stocks. Instead, it has what's called fixed income, which is what this Morningstar website refers to as bonds. So I own a bunch of different bonds, and I don't really think I'm going to spend time explaining how the bonds get broken down, but what I will say is that this fund kind of diversifies my bonds. So there's a lot of different bonds you can buy. You can buy bonds from companies, you can buy them from governments. So this fund puts money into a bunch of different bonds for you. So I own this, and I buy this every month. I buy a lot less of this than I buy of this fund, because these stocks, I'm going to take on more risk, but I'm going to expect them to grow more. So for the time being, about 90% of my money that I'm putting into my retirement accounts is going into stock funds, and about 10% of it is going into this bond market fund. The only other fund that I'm currently buying is this one right here. So this is another Vanguard fund. This is a total international stock mutual fund. So you can see here, it's a little more expensive. I would think for the expense ratio, I'd think because it's a little harder to manage buying all these international funds. But let's take a look at what's within this fund. So right here, U.S. equity. So very little U.S. stocks, essentially none. Non-U.S. equity. This means international stocks. So stocks that aren't public in the U.S. Basically 100% essentially non-U.S. stocks. So if we look at the top 10 holdings, you'll still recognize some of these companies probably. Like for example, Samsung. I own Samsung phones in my life. That's a company that I believe is headquartered out of South Korea. And so yet you got Toyota, people love Toyotas here. So these are all international companies. And so it's very similar to the total US market fund that I own in the sense that all the money that I put into this gets spread across a bunch of different companies. So let's see, look at this. This fund has almost 8,000 companies that I'm buying. So by putting money just into this mutual fund, I'm actually putting my money into almost 8,000 different companies. And so this is an incredibly easy way, a very simple way to buy 3 different funds. And look, I bought essentially all of the companies in the US. I bought a ton of different bonds within the US. And then I bought like 8,000 international companies, which is a ton. So this is a very simple way. I only have to manage putting my money into 3 different funds. So essentially I could put 60% of my money into this US stock market index, 10% of it into this bond market index, and then 30%, let's say, into this international stock index. And that easily I can just automate money into each of these every month and have a very diverse portfolio with 3 mutual funds that are all inexpensive. So you'll see that you'll come to know that if you look at expense ratios, these are all incredibly cheap funds to own. $4 for every $1,000 I put into it. And so this is actually my current strategy on how I'm investing for retirement. And the idea is that if I put money every month into these 3 funds, over the course of my life, they're gonna grow. And I'll take advantage of this compound growth and the interest rates that the combination of these funds are offering. So if we look at performance, international stocks as of late have not been doing nearly as well. So for example, you'll see quite a few of these are negative here compared to the US where we had, some 30% gains and stuff like that. But this allows me to be more diverse rather than just investing in US companies. I can be very diverse by adding 8,000 more companies. And so this strategy with these 3 funds is actually a strategy that's fairly well known, that's kind of called the 3 fund portfolio. And you can do research on 3 fund portfolios. There's tons of YouTube videos and articles about why this is an effective way as to be a very average investor, cover your grounds, keep it incredibly simple, keep your price very low, and buy a few different things. So these are the actual investments that I'm going to put inside my retirement accounts. So for example, in my Roth IRA, every month I might put $375 into this fund. And I'm just going to buy that over the course of my lifetime and hope that that grows. And we expect it to. So these are 3 different mutual funds. And I own each of them, and you might look into doing a similar strategy for yourself. In fact, you might make it even simpler and just buy these 2 funds and skip the international funds altogether. There's a lot of debate on the best way to choose investments because everyone wants this number right here, this interest rate, to be as high as possible. As we've seen from the first two videos, where if you play with this, it starts to do crazy things to your wealth. So for example, if we got 30%, like the best year I think we looked at in this fund right here, the total stock market of the US, 30.8%. If we got that every year, look at this. 3 trillion, is that what that is? That's $3 trillion. So essentially, if you got that every year, you would have crazy amounts of money. But we don't expect to get that every year, and we kind of know that you never will get that every year. And so that's where I was pointing out that the average of this over the course of its history is more like 11%. And so, you know, you'll have big years where you lose. Like if you put a bunch of money into it this year, it's down quite a bit, right? And so you just want to be diverse and invest over the long haul. And this is kind of a look at where this interest rate actually comes into play quite literally in some examples. So I hope that helps explain a few different actual investments that you could buy. These are investments that I buy. You could also just buy an individual stock like I talked about in the last video. But I wanted to give some of the individual stock basics so that you would be able to understand these mutual funds a little bit better. And so I think this is a really smart and simple way to go about investing that makes sense, and essentially you can stick to this. You can continue to put money into this. Yeah, so I hope that helps understand what a mutual fund is, and maybe gives you some inspiration for looking into how you want to invest. Look at that, 3 trillion if we get 30% every year. Wouldn't that be sweet? But let's come back to reality and set this back to maybe a more standard return, which is 7%, and now we're back in the millions, so I'm still very happy. So I hope that helps.